Ladies and gentlemen, Justin Chen here. Put down whatever's in your hands and look at this. Not the headlines, not the speeches, not the talking heads doing their little synchronized dance on television, but the raw numbers that moved when a real-world shock punched through the paper theater. You woke up on Monday, January 5th, 2026, and the metals market didn't trade. It flinched. Spot gold jumped about 2.2% to roughly $4,424.17 per ounce, and spot silver climbed about 3.9% to roughly $75.50. And the only people acting surprised are the people paid to keep you calm. They'll tell you it's safe haven demand, like that phrase is a sedative you're supposed to swallow without water. They'll tell you this is about a geopolitical headline, one dramatic weekend event, one captured president, one shock and awe moment that scared the market into buying shiny things. And yes, Reuters reported that the U.S. capture of Venezuela's Nicolas Maduro lit the fuse on a flight to safety, and you can see it in the tape. But listen to me carefully, because this is where they always win if you're lazy with your attention. This is not about Maduro. This is about the plumbing underneath the global silver market getting squeezed from two directions at once, and the price move is just the scream you hear when the pipes finally groan loud enough to echo through the walls. You think you're watching a price rally. You're watching something else. You think you're watching the right thing. You're not. You're watching the loud, easy, televised thing because the system trained you to. You're watching the decoy while the mechanism tightens like a fist. They want you staring at the wrong screen while the physical world quietly takes the wheel. I know where you were when this started. You were coming off a holiday stretch, half awake, telling yourself you'd get serious after the calendar flipped, because that's what normal people do. They let the year reset their courage. And I told you about this weeks ago, didn't I? I interrupted your quiet holiday haze to show you the signal before it went nuclear. Today, it just did. So don't let them hypnotize you with the word safe haven, because that's the oldest trick in the cartel's book. They slap a label on a move, they sell you a bedtime story, and while you're repeating it to your friends like you discovered it yourself, they use the confusion to reposition. If you're new here, welcome to the part of the movie where the villain stops hiding in the shadows and starts doing the crime in daylight. If you've been with me for months, you already know the rule. The headline is the decoy, and the mechanism is the truth. Look, what's the decoy today? The decoy is that one weekend operation, one political bombshell, one dramatic arrest narrative that makes gold and silver look like they're reacting to fear. That's the story that travels well. That's the story that keeps you thinking the market is emotional, random, driven by vibes and tweets and sentiment. But the mechanism is uglier, colder, and more predictable. The mechanism is that silver is not just a precious metal anymore. It's a strategic input. And the world is quietly turning strategic inputs into controlled substances without ever using that phrase on camera. Let me translate what you're seeing in plain English. When gold rips higher to an all-time peak range and silver follows, you're not watching retail enthusiasm. You're watching institutions, industrial buyers, and sovereign players treat volatility like a tax they're willing to pay to secure supply. And the reason they're willing to pay that tax is because the game has changed. Not on your brokerage app, not in your little candles and indicators, but in export rules, licensing regimes, and warehouse categories that decide what can be delivered and what is merely eligible to exist in the building. Let's talk about that word because it's one of those words designed to make you sleep. Eligible sounds friendly, like your metal is waiting in line for a scholarship. But in this market, eligible means the bars meet the specs, but they are not committed to delivery, not attached to a warrant, not promised to the futures machine when the bell rings. Registered is different. Registered is the part of the pile that can actually be delivered against the contract, the part that can settle the paper promise when somebody says, "Fine, give me metal." Registered is the chair in the musical chairs game, and eligible is the person standing near the chair saying, "Yeah, I could sit, but I don't have to." And if you want to know whether a market is healthy, you don't start with the price. You start with whether the chairs are being quietly removed while the music gets louder. Because that's how squeezes are born, not from Reddit memes, but from constraints. Here's the first core signal you need to hold in your head like a knife. On the CME's Daily Silver Stocks Report, dated Friday, January 2nd, 2026, with activity dated Wednesday, December 31st, 2025. There's the kind of line item you only see when someone is rearranging the furniture before guests arrive. A large adjustment shifts roughly 900,000 ounces out of registered and into eligible, which means the deliverable pile shrank on paper, even if the metal didn't leave the building. They'll tell you that's normal, that's bookkeeping, that's operational, nothing to see here. And sometimes it is. Sometimes the warehouse clerks are just doing their job. But in a market that is already tight, in a market where volatility is turning into a weapon, that kind of move is a message, because it changes the answer to one question. Can you deliver? Walk with me through the math, because the math is where the lies go to die. 900,000 ounces is not a cute number, not a coin shop number, not a I bought a tube of Eagles number. 900,000 ounces is roughly 28 metric tons of silver, moved out of the deliverable category with one adjustment line, like someone sliding a stack of chairs behind a curtain. Now take that same pile and put a price on it, just to feel the weight. At roughly $75.50 per ounce, that shift represents around $68 million of metal being reclassified in a way that reduces immediate settlement capacity. $68 million is not a rounding error, and it is not a coincidence that the deliverable pile gets adjusted right as volatility spikes and narrative pressure rises. And here's the part that should make your stomach tighten. That adjustment is not metal leaving the system, it's metal being protected from the system, because eligible bars are still in the vault, but they are no longer obligated to answer the paper call. That is not about logistics. That is about control. So ask yourself, like a prosecutor, not like a spectator. If everything is fine, why do you need to quietly shrink the deliverable pool right when the market is already moving like a patient having a seizure? If the promises are safe, why are you making the promises harder to redeem? If the casino is honest, why are the dealers quietly removing chips from the table while telling you to keep betting? This is not about a price spike. This is about a settlement system that only works when the majority of players never ask for what they bought. This is about a paper market that survives by convincing you that a claim is the same thing as the thing. They built a religion out of that confusion. They trained you to think your brokerage statement is ownership. They trained you to think an ETF share is the same as a bar. They trained you to think liquidity means a healthy market when sometimes liquidity is just the ability to shove risk onto someone else fast enough to stay alive. And right now, the risk is not just volatility. The risk is that the world is turning silver into a strategic choke point while the Western price discovery mechanism is still pretending it as a normal commodity. That mismatch is where the fireworks come from. Which brings us to the second core signal, and this one is not hidden in a warehouse spreadsheet. This one is a policy gate, and gates are the most important things in economics because gates decide who gets to breathe. Starting Wednesday, January 1st, 2026, China rolled out a new export licensing regime for certain critical minerals, and Reuters reported that Beijing named 44 companies allowed to export silver over 2026 to 2027. Read that again, slowly, like you're reading the fine print on a contract designed to hurt you. 44. Not any qualified exporter, not the market will decide. 44 companies on a list, which means every company not on the list is zero. That's not a policy tweak. That is a spigot. They can call it licensing to make it sound bureaucratic and boring. But licensing is rationing with better branding. Licensing is how you turn a commodity into permission. Licensing is how you make supply political without ever saying the word embargo. Here's where the cartel's narrative trick kicks in again. They want you to treat China's export gate as a distant, abstract, slow-moving thing that doesn't matter today. They want you to keep your eyes on the candle on your screen because the candle is loud and the licensing list is quiet. But the licensing list is the knife and the candle is just the blood. Because once you put a gate on export, you change behavior everywhere in the chain, even if the volume doesn't change on day one. You change hoarding. You change forward contracts. You change who takes delivery early. You change who demands premium. You change how much inventory is available versus available if you beg. This is not about China exporting more or less next week. This is about every industrial buyer on earth hearing one message: supply will be managed. And when supply will be managed, people stop trusting just in time. They start buying just in case. And just in case buying is how shortages begin, because it's rational behavior in a world where the gatekeeper has announced he has a gate. You don't wait for the first shortage headline to act. You act when the rules change, because rules changes are the earliest form of the future. Now, tie these two signals together, and you start to see the shape of the trap. On one side, you have a paper market built to settle with cash, to delay delivery, to roll, to net, to offset, to keep the physical demand from ever fully expressing itself. On the other side, you have a physical world that is being gated, licensed, and militarized, where silver is not just jewelry and coins, but electronics, energy, defense, and the infrastructure of modern life. When those two worlds diverge, you get premiums, you get arbitrage gaps, you get delivery stress, you get sudden adjustments in warehouse categories, and you get the kind of price behavior that looks irrational until you realize the market is not clearing, it's rationing. Now let's talk about the third core signal, and this is where the story gets cruel, because it's the part that exposes who is protected and who is trapped. Reuters noted that gold had a record year in 2025, up around 64%, and silver ended the year with a massive gain, with the kind of number that should have been front page news if the media wasn't tea glued to the mouth of the banking system. A market that moves that far in one year is not a normal market. A market that moves that far is a market repricing something it was not allowed to price honestly before. It is like watching a lid pop off a boiling pot after years of someone standing on it with a boot. And when a lid pops, the first thing the system tries to do is control the story. They'll tell you it's speculation. They'll tell you it's fear. They'll tell you it's overbought, like the only sin a market can commit is moving too much. They wanted to tell you the real reason, that the old price implied a world that no longer exists. Because the old price implied trust. It implied that you could buy paper and get metal if you wanted it. It implied that global trade was frictionless. It implied that export gates wouldn't appear overnight. It implied that geopolitical shocks were rare, containable, and politely priced. But the world you live in now is different. In the world you live in now, a dramatic geopolitical move can hit the tape over a weekend, and the metals market can gap higher like a heartbeat returning after a flat line. In the world you live in now, the biggest manufacturing nation on earth can tell you with a straight face that only 44 companies get permission to export silver, and the West will still pretend price discovery is a free market process. So let's cross-examine this like adults. Why would China bother with an export licensing gate if silver was abundant and unimportant? Why would the deliverable category on a major Western exchange shrink by an adjustment line if deliverability was not a concern? Why would silver be ripping to fresh peaks if this was just a panic bid that would fade by lunch? And the answer is the same answer it always is. They knew. You didn't. They positioned. You reacted. They wrote rules. You stared at charts. This is not about politics. This is about leverage. This is about collateral. This is about who has to post margin when volatility spikes and who gets to change the rules when their positions start bleeding. Margin is the quiet executioner in these markets, and most people don't respect it until it drags them out back. Margin is the cash you must post to keep a leveraged position open. And when prices move hard, margin calls hit like a sudden tax bill due in an hour. And when margin calls hit, forced selling happens. Not because someone changed their mind, but because the system demands blood. This is why paper smashes work in a rigged casino. Because they don't have to convince you to sell, they just have to push the price far enough, fast enough, to trigger forced liquidation. I'm not saying that's what happened today. I am saying that it's the mechanism they keep in their back pocket like a blackjack dealer with an extra ace. And when you see deliverable inventory quietly shrink and export gates quietly rise, you should assume the dealer is checking his sleeve. Now, let me give you an analogy that even the most bored viewer can feel in their bones. Imagine a city where water is traded on paper. Everyone buys water credits because it's easy and it's liquid and the price is stable and the television says it's safe. Then one day, the government announces that only 44 companies can export water out of the region. And at the same time, the city S main reservoir quietly reclassifies a chunk of its water from deliverable, decoy, to available, but not promised. What happens next? The water credits might still trade, but the meaning changes. Suddenly, the credits are not a claim on water, they are a claim on a system that may or may not choose to honor the claim. And that's when people stop asking, what's the price? And start asking, can I get it? That pivot is everything. That pivot is where wealth changes hands. That pivot is where trust snaps. And once trust snaps, you don't go back to normal by next Tuesday. This is why I keep telling you the market is not a scoreboard. It's a crime scene. The price is not a neutral number. Sometimes it's a confession, the kind you only get when the suspect realizes the evidence is too strong to keep lying. Let's talk about the confession hiding inside today's headline move. Reuters framed it as safe haven demand after a controversial capture, and that's true as far as it goes. But a safe haven bid does not explain why silver is behaving less like a sleepy precious metal and more like a strategic commodity that cannot be allowed to trade freely for too long. Silver is the metal you don't notice until it's gone. It's in solar panels, it's in electronics, it's in medical systems, it's in defense applications that nobody lists on a cheerful brochure. It's the kind of input that has no easy substitute in certain uses, which means when it gets tight, it doesn't negotiate. It dictates. And that's why the gate matters. That's why the warehouse category matters. That's why the year-to-date repricing matters. Because those are all signals that the world is waking up to silvering ES role in the machine. And the people who run the machine hate waking audiences. They prefer you sleepy. They prefer you distracted. They prefer you arguing over whether the chart looks somehow overextended and while they rewriting the rulebook. Because if you're arguing about candles, you're not asking about deliverability. If you're arguing about momentum, you're not asking about export permits. So let's do the math again, because repetition is how you train your mind to stop falling for the same scam with a new face. Think about what it means for settlement when nearly 28 metric tons are shifted out of the registered category, even if the metal stays in the building. That shift is not just a number, it's a reduction in immediate settlement capacity. And settlement capacity is the only thing that makes paper credible. Now zoom out. The combined stockpile in the comics-approved warehouses is hundreds of millions of ounces, which sounds like a lot until you remember that warehouse stock is not the same as bailable. I am as available to deliver, and available to deliver is not the same as available at a price you can pay. In a tight system, the marginal ounce sets the rules, and the marginal ounce is the one that is hardest to pry loose. And that's the part nobody on television will tell you, because it's too honest. Markets don't break because they run out of total supply. They break because they run out of floating supply, the supply that will actually show up on the other side of a contract without a fight. You can have a warehouse full of metal and still have a crisis if most of that metal is owned by people who do not want to sell or do not need to sell or have been given a reason to hold tighter. That's how you get rationing. That's how you get premiums. That is how you get the kind of healthy liquidity narrative turning into a joke told at your expense. Now, here's where the betrayal becomes personal, because this is where you realize who the system is designed to protect. When volatility spikes and geopolitical shocks hit, big players don't panic the way you do. They hedge, they collateralize, they call their prime broker, they shift inventory categories, they get exceptions. You, on the other hand, get told to stay calm, while your purchasing power gets quietly bled out by inflation and fees and spread. They call that stability. I call it a slow robbery. The betrayal of savers is not a theory, it's arithmetic. When central banks expand balance sheets and governments run deficits like they're allergic to discipline, your cash becomes a melting ice cube. They tell you it's fine because the nominal number stays the same, but the real value evaporates like water on a hot plate. And then, when people try to defend themselves by moving toward real assets, the system tries to corral them back into paper wrappers. Because paper is controllable, paper can be created, paper can be levered, paper can be settled in cash. Physical is stubborn. Physical force is delivery. Physical force is truth. This is why I keep hammering the paper versus physical distinction. Not because I want you to join a cult, but because I want you to understand the battlefield. Paper claims are the System S preferred weapon, because they allow the casino to offer more bets than it has chips. Physical is the chip. Paper is the receipt for a chip that may or may not exist when everyone shows up at the cage at once. And the whole game depends on the crowd never showing up at the cage at once. That's the quiet pact. That's the unspoken agreement. That's the thing they pray you never understand. Now, let's bring Maduro back into the story, not as the main character, but as the spark that revealed the dry tinder. Reuters described the capture as heightening geopolitical tensions and spurring safe haven demand, and you can debate the politics all day if you want. But the market doesn't debate, it prices. And what the market priced on Monday was not just fear. It priced a world where political moves can interrupt trade, where sanctions and seizures and operations can rewrite flows overnight, and where the safest assets are the ones that can TB printed in response to a press conference. That's why gold moved. That's why silver moved. That's why the price didn't politely wait for your calendar invite. The market doesn't care about your schedule. The market cares about constraints. So when you see silver pushing up into the mid-70s in dollar terms per ounce, don't treat it like a meme. Treat it like a signal that the world is repricing what it takes to secure an ounce in a gated, volatile, politicized supply chain. And when you see China naming 44 exporters, don't treat it like a trivia fact. Treat it like a blueprint. Because when a country tells you it will manage exports of a strategic input, it's telling you it is willing to use that input as leverage. And leverage is the currency of geopolitics. This is not about China versus the West as a sports rivalry. This is about how nations behave when they understand that raw materials are power. And if you think this ends with polite trade flows and fair price discovery, I have a bridge to sell you, and it's financed with derivatives. Now let's talk about derivatives, because that word scares people the way the word surgery scares them. Derivatives are contracts whose value is derived from an underlying asset, and in theory, they are risk management tools. In practice, in captured markets, derivatives become a way to create a shadow supply, a paper supply that can be expanded to dampen price signals that would otherwise force scarcity to be acknowledged. This is why I call it financial theater. They build a stage where paper actors perform abundance while the physical backstage crew is sweating, rationing, and praying. The audience never demands proof. And the audience is you. You are the one being told the show is real. You are the one being told the lighting is natural, the sets are authentic, the plot is organic. Meanwhile, the producers are rewriting the script between scenes to keep the ending from happening. But there are moments when the script slips. There are moments when the mask cracks. There are moments when a headline shock hits. At the same time, a policy gate tightens and a warehouse category shifts. And suddenly the theater can't fully hide the mechanics anymore. Monday was one of those moments. Now I can already hear the objections from the faithful. Justin, inventory still exists. Justin, it's just reclassified. Justin, the market is liquid. Justin, China has always had lists. Justin, it's all priced in. And this is where I tell you the most important reversal of the night. This is not about whether inventory exists. This is about whether inventory is willing to serve the paper market when demanded. Because in a true physical squeeze, the metal doesn't disappear, it simply refuses. It refuses to move at yesterday's price. It refuses to be delivered to settle yesterday's promises. It refuses to play the role assigned to it by people who think they own reality because they own the printing press. That's how shortages look in modern finance. They don't look like empty vaults. They look like full vaults with locked doors. They look like eligible stock that stays eligible forever. They look like premiums that won't go away. They look like delivery notices that spike. They look like sudden rule changes and margin hikes and temporary measures that somehow become permanent. I'm not asking you to panic. I'm asking you to stop being naive. Those are different things. Panic is emotional. Awareness is strategic, and the system hates strategic viewers. The system loves emotional viewers because emotional viewers can be stampeded. Emotional viewers can be shaken out. Emotional viewers can be margin called into submission. Strategic viewers just sit there, watching the plumbing, waiting for the truth to reveal itself. So let's map the chain reaction, because this is where the story escalates from interesting to dangerous. When a geopolitical shock pushes safe haven demand higher, prices move. When prices move, margin requirements become relevant. When margin requirements become relevant, leverage players feel pain. When leverage players feel pain, forced flows happen. At the same time, when export licensing gates tighten, physical supply becomes less flexible. When physical supply becomes less flexible, the cost of securing immediate delivery rises. When immediate delivery costs rise, the spread between paper and physical can widen. When that spread widens, arbitrage players step in, and arbitrage is the part of the story everyone misunderstands. Arbitrage is not a magical force that makes markets fair. Arbitrage is a trade that exploits price differences between markets. And it only works when the thing you're arbitraging can actually move. If the gate is closed, arbitrage becomes a trap, because you can't complete the loop. So if you have a paper price in one place and a tighter physical price elsewhere, the gap can persist longer than people expect, not because the market is dumb, but because the market is constrained. And constraints are the enemy of the efficient market. Fairy tale. This is why I keep saying the headline is a decoy, because the headline gives you a story that ends quickly. Maduro captured. Metal spike, everyone calms down. That's a tidy arc. That's a television arc. But the real arc is structural. The real arc is that policy gates and deliverability categories are tightening as volatility increases, which means the system is becoming more brittle, not less. And brittle systems don't break in slow motion. They break in snaps. Now, let's push into the high stakes part, because I want you to feel the betrayal clearly enough that you stop negotiating with it. The betrayal is that they sold you the idea that markets are neutral, that price discovery is honest, that the system is designed to allocate resources efficiently. Meanwhile, behind the scenes, they built a machine designed to allocate pain efficiently. The pain is always allocated downward. When things go wrong, insiders get lines of credit, policy exceptions, regulatory patience, and media narratives that paint them as necessary. You get inflation. You get higher costs. You get temporary emergency measures that become the new normal. You get told to tighten your belt while the people who tighten the rules loosen theirs. And in metal specifically, the betrayal is that they used paper to suppress signals that would have forced honest discussion about scarcity years ago. They kept the price tame enough to preserve the illusion that the system could supply unlimited growth, unlimited tech, unlimited energy transition, unlimited everything, without any constraint biting. Now the constraints are biting, and instead of admitting the truth, they're trying to manage your attention. They're trying to keep the public conversation on politics, on drama, on personalities, on everything except the math and the gates and the settlement capacity. So here comes the second do the math moment, because I want this burned into your reflexes. Reuters said silver ended 2025 up around 147%, and gold up around 64%. And those numbers are not just bragging rights. Those numbers are a clue that a long-suppressed signal is being allowed to speak. When a market rises that hard, it forces every institution with a short exposure to reevaluate their collateral, their hedges, their balance sheet risk. It forces funds to explain drawdowns. It forces banks to manage margin. It forces the whole paper stack to admit that volatility is not a side effect. It's a threat. Now combine that with a licensing gate and a deliverability shrink. That's like lighting a match in a room that smells like gasoline. You might not get an explosion in the first second, but you're not dealing with normal risk anymore. You're dealing with compounded fragility. And fragility is the enemy of leverage. Fragility destroys people who think they can borrow certainty, because leverage is borrowing, plain and simple, borrowing money, borrowing time, borrowing calm. And when calm disappears, leverage becomes a noose. So if you're sitting there thinking, okay, Justin, what do I do? I'm going to remind you of the boundary, because I'm not here to hand you a trade. I'm here to hand you a lens. I'm not telling you to buy, sell, or hold anything. I'm telling you to stop treating this like entertainment and start treating it like a system that affects your life, whether you participate or not. Your mindset matters here. The system wants you reactive, chasing headlines, chasing candles, chasing social media noise. Your job is to become the person who sees the gate, who sees the category shift, who sees the supply chain move, and who understands that the chart is downstream of those forces. Because if you understand that, you stop getting emotionally whiplashed by every red candle and every green candle. You stop letting the cartel use your nervous system as a profit center. You stop playing the role of the scared tourist in a city where everyone else has a map. Now, let's talk about the climax, the part where the betrayal becomes undeniable. The betrayal is that they are turning markets into administrative systems, where access is controlled, where deliverability is optional, where export is permissioned, where volatility is weaponized, and where the public is told it's all just normal market behavior. That is not a free market. That is a managed outcome machine. That is a rationing system with a price tag. And once you see it that way, a lot of mysteries disappear. Sudden spikes make sense. Sudden smashes make sense. Inventory categories matter. Licensing lists matter. Geopolitical shocks matter, not because they're dramatic, but because they accelerate the shift from open flows to gated flows. This is not about a single weekend operation. This is about a world that is moving from abundance narratives to constraint realities, and silver sits at the intersection of that shift like a tripwire. So when you hear someone say, it's just a safe haven rally, you should laugh, darkly, like someone who has seen this movie too many times. Safe haven is a symptom. The disease is trust collapse. The disease is that people are no longer willing to bet their future on paper promises issued by institutions that have been lying for decades. And that's why today matters. Not because your screen was green, not because the number was exciting, but because the system flashed you a warning label. And if you're smart, you read warnings before the fire reaches the curtains. I'll give you one more image and then we'll bring it home. Think of the financial system like a massive cruise ship with a beautiful ballroom and 1,000 people dancing under chandeliers. The band plays, the champagne flows, and the captain smiles for photos. But down in the engine room, the pipes are leaking, the gauges are flickering, and the crew is quietly moving fuel from one tank to another to keep the lights on. Most passengers never see the engine room, they just dance. But when you see a reclassification of deliverable metal, when you see an export gate, when you see a geopolitical shock push metals to peaks, you are hearing the engine room alarm. It's faint, but it's real. And the people in charge will do what they always do. They will keep the music loud. They will keep the headlines dramatic. They will keep the passengers dancing because panic is bad for business and truth is bad for control. Your job is not to panic. Your job is to notice. Your job is to stop being the passenger who argues about the band S tempo while the ship lists. So here's what I want you to carry with you after this video ends. Watch the gates. Watch the deliverability. Watch the difference between eligible and registered. Watch the behavior around settlement and margin and rules, not just price, because the story they're selling is always softer than the math they can't escape. They will keep telling you everything is under control because under control is the phrase that keeps the con alive. But control is exactly what's being asserted, and that is the confession. When exports are licensed, control is asserted. When deliverable inventory shrinks by adjustment, control is asserted. When volatility is used to shake weak hands out of the room, control is asserted. And the moment you accept that, you stop being shocked. You start being prepared. Not for a specific trade, not for a specific date, but for the reality that this system is transitioning from pretending to be fair to openly managing outcomes. My name is Justin Chen. If you want to walk through this fire with me, hit subscribe, share this with someone who's still asleep, and I'll see you on the other side.